Welcome to Wealth Well Done. Together, we'll cover a wide range of important topics surrounding money and the impact it has on our lives. From the sophisticated and highly valuable planning techniques of the ultra-wealthy to the commonly underutilized biblical teachings. Together, we'll work to improve our relationship with money and our effectiveness in stewarding it well. Here's your host, Eric Scovill.
All right, welcome to the next episode of the Wealth Well Done podcast, where we share tactical, practical, and spiritual advice to help you do your wealth well done. Last week, we had to sit down with Isaac Bennett as we went over his approach to understanding how investments actually work and how to approach investments differently. This week, we have the privilege to interview the CEO of REM Capital, Robert Ritzenthaler. Robert is a multifamily investor here, and Isaac mentioned quite a bit last week of how big of a proponent he was of real estate, especially multifamily. And so that feeds perfectly into this next conversation here with Robert. Full disclaimer, regardless of whether someone is licensed or has a fiduciary responsibility, all the strategies, suggestions that we offer in here are meant to be generic and informative. They are not financial advice to a specific listener. So please do your own research, consult your own team of licensed professionals to decide if any of these decisions make good sense for you. Second disclaimer here, as was with last week, I do business with Robert and with REM Capital. So there's a reason why I do that. There's a reason why we have found this partnership together, but I also don't want to have you feel like at any point we're trying to hide something here. So Robert's going to share a lot of information to help educate you on real estate, on investing in general. And with that, we'll also find out what he has going on within REM Capital. So without further ado here, I'd like to introduce Robert Ritzenthaler. Robert is the founder of REM Capital. REM is this incredible gem of a real estate company here, which has a focus on conservative, steady, kind of middle of the fairway type multifamily investments, as well as how we've been looking at them. They should eclipse $500 million in assets under management this year and probably go well beyond that. So Robert, would you maybe give the listeners a little bit of background on REM Capital?
Absolutely. And good to be here. Thanks for having me on the show.
Thanks for being here.
Exciting to share, hopefully, some helpful knowledge along the way.
Right.
But so a little bit about REM. It's been about, 5 or 6 years ago now since we started REM. And ironically enough, there was no grand plan. So it was kind of just, you're doing your thing, you're working hard, nose down, and all of a sudden, stuff starts happening. And that's kind of how REM came about. I actually thought when we started, I did do a basic business plan, just kind of, okay, well, what kind of cash flow, this kind of thing. And I thought, hey, if we had 100 million in 5 years, that'd be pretty sweet. I'd be good with that, Right. Worked in corporate for, a couple decades. Always thought about doing my own thing, but, it's a pretty big jump to go from W-2 to making the rain.
It certainly is. I imagine a lot of listeners on this, listeners here have done that W-2 to entrepreneurial jump.
Yeah, it's a big jump, but it works out really well, and I'm excited that it has gone beyond expectations. And as you mentioned, we're about $500 million today after 5 years. Kind of enjoying the break in the market, honestly, right now, where it gives us a little pause to focus on our operations, build out our team, really hone in on the core of our business, which is property management 101. If you're in this business, that is your business.
Right. And so your portfolio of properties, can you give a brief overview on what type of properties you manage now?
Yeah, so we are primarily workforce housing, so B and C class properties all across the Southeast, the Midwest, and Texas. Got about 4,000 units, over 24 properties in mainly major markets. So Cincinnati, Columbus, Dallas, San Antonio, Houston, Charlotte, Atlanta, Orlando, some smaller markets too, but a lot of larger markets where we feel like we can provide value, buy some older product, fix it up. And, there's no new product being built at that price point. So it's kind of it's a good business plan. I mean, it's been working for decades, but obviously it's worked really well the last decade.
Right, absolutely. So then the scale of the properties that you are acquiring now, what type of scale are we talking about?
Yeah, so I would say, excuse me, for the most part, it's 100 to 300 units, kind of call it 200 unit average unit size that gives us the ability to have full-time on-site staff, get a little bit of economies of scale in terms of production for renovations and things of that nature. And then obviously, trying to build out each of our areas to where they have scalability. So
Okay.
Dallas is an example. We got 3 properties in Dallas, 3 properties in Atlanta, larger markets. And it's nice, you get a team built up where you've got a few maintenance folks. They can kind of float around. Somebody's on vacation. You don't miss a beat. Not a big deal. So that's been really nice.
Okay.
And obviously, as we continue to grow, we'll see the benefits of that economies of scale too, which is going to be exciting. So
Right. All right. Well, thank you for that. I want to jump right into the hard part. Any entrepreneur, and honestly, everyone, we've all experienced failures. We've all experienced lessons learned the hard way. I think we often, I've shared my prayer is often to, Lord, let me learn lessons the easy way. Let me pick up things from wisdom of other people, wisdom from the Bible, to learn lessons the easy way. But you've been through a couple of the big ones here. You have been in the tech world in 2001, you have been in real estate in New York in 2008, and you've obviously been in real estate then during COVID as well. And I was wondering if we could go over a lesson that you've learned from each of those, whether it's a round of failure or just an opportunity, what worked well or what didn't. Like, what's a lesson that you learned from each of those different economic downturns?
Absolutely. I always love to share that because I think it's important to not forget the difficult lessons.
Yeah.
In fact, I saw a great post the other day. I think it was on LinkedIn. Somebody said something about, I've had great things that have lifted me up, situations lifted me up, and then other situations just crushed me. And I'm thankful for both. And I can honestly say that because you learn a lot more about yourself in the situations that crush you if you're humble, if you're willing to learn.
Right.
And I think those are what mold you for future greater success, really.
I couldn't agree more. There's a sermon that I listened to here not that long ago that talked about that, and I actually became incredibly grateful for the hardships that one of my businesses has faced this last year, and then even just this whole entrepreneurial journey. That like it's taken this long, but now through that, on the other side, and I'm not even on the other side of some of that yet, but just in the middle of it, just realizing God's got a plan and it's going to work. I just found myself being incredibly grateful and not needing to control the outcome and get to the pinnacle of success tomorrow.
Right.
So,
I think that's one of our biggest dangers in America is that we subconsciously prioritize the dollar as number one on the list. Subconsciously.
Absolutely.
I don't do it consciously, but subconsciously, I think we do that. And so it's a constant, I don't want to call it a battle, but it's something I think we got to remind ourselves that isn't the number one priority. It's, it's our family, it's our faith, it's a lot of other things.
Right.
So anyway, but back to your question, just one example that I like to give, as you mentioned, I used to work on Wall Street before I got into real estate. And so I had actually been investing since I was probably in junior high school.
Okay.
I was one of those oddballs that, went to the library, opened up the Morning Star report. And was like, where am I going to put my money?
Right.
No computers, no internet. It was just paper and pencil back then. But I just, I had a real desire and an excitement about being able to invest and allow other people to, use my capital, obviously, to grow, but then receive a profit from that. And it was a pretty cool model. I thought, hey, I'm making money while I'm sleeping. What's wrong with that?
Right.
So I did that for a number of years, kind of helped pay my way through college doing that. And then when I graduated with a finance degree, I said, well, I'm going to go to New York and we're going to do this professionally. So I actually started a small hedge fund and raised some capital and started investing. And my specialty was pre-IPO technology shares. You can only imagine what that was like before and after the tech bubble.
Right. No wonder it drew you into it in the beginning.
Right.
Yeah.
So in the beginning, making great money. And then, of course, it all kind of went up in smoke at some point. And one of the things that I learned through that was that sometimes the word that, not that I didn't know this, but sometimes the word that you give to your investors is more important than the contract that you sign with your investors. And I think that in business, most people will fall back on the letter of the contract. And I've always felt like that's the minimum. And that if you are going to live bigger and better than that, then you should live by the spirit of the contract. And so with the investors that I had, I decided to shut down the hedge fund. Obviously, the market had crashed and kind of game over. Right. But over the next, I want to say 3, 4, 5 years, I took a portion of my personal W-2 earnings. I went back, went into corporate real estate, and I paid a good chunk of that investment back to them. And it wasn't something that I had to do. I mean, we all took a risk. We all took a loss. The market crashed. It wasn't like I was in the Bahamas with what's his name, Sam Freed.
With SBF.
It was just the market crashed, and nobody would have known. But I did feel some obligation to these people, and I knew them. They were friends of mine. I had a relationship with them, and so I felt some obligation to do what I could to try to help them get back whole. And I didn't get them whole. It wasn't like I was some multimillionaire, but I just took that as an opportunity to feel a little bit of pain. Yeah. And to really kind of burn it into my brain and say, hey, this is serious stuff. And, next time we do this, we're going to be a little more careful so that this doesn't happen.
That is tremendous. What that says about your character. Yeah.
Yeah. And I feel that way today. I think there's a balance, obviously, between overcommitting to something. You got to think practically. You can't always, be the hero. And that's a human tendency too.
Right.
And we've had to, a couple of deals recently, we had to cut distributions. First time we've ever had to do that. And, I didn't want to, but there was kind of a practical element of, hey, the market's tough and we've hit some bumps in the road and we need to preserve cash. But I also didn't think we needed to completely cut distributions. And I think a lot of people would have said, oh, we're done. We're not paying anything. We're out. And I just felt like, maybe we do, maybe we don't. Let's give it a little bit of time. Let me work really hard to see if I can kind of turn the corner here on these couple properties and get us back on our feet. So, at the end of the day, we all make business decisions, right? And I just feel strongly that if you're serving others, I think at the end of the day, you're going to see good results. Yep. You might not be the next gazillionaire, but again, that's really not the goal. The goal is to help other folks along the way, and usually you're pretty successful in doing that.
Right. I love it. All right. Thank you. So what about doing real estate in New York? And were you downtown New York, or where were you at in 2008?
Yeah. So, in 2008, I was actually in Tampa.
Okay. You're in Tampa. Okay.
I was working for a REIT at the time. New York was mainly, Manhattan, a little bit we had properties in the Bronx, Queens, out in New Jersey. So kind of all over the place. And It was value add, it was office, it was redevelopment, mixed use, all kinds of different stuff. So it's great. And I'm really thankful for that, to be honest with you, to start in commercial real estate in New York City, like any big city. I mean, it's one of the great sandboxes of the world. So you can really learn a lot.
Right.
And I had a couple of great owners, partners that I worked under that kind of had that old school mentality. They said, hey, let's give you an inch, see how you do. If you do well, we'll give you a foot. And if you do well with a foot, we'll give you, a few feet and just let you run with it.
Yeah.
So it's great. They were great mentors, helped me really learn the business, guided me along my path as I really grew in the business. And I'm very appreciative of that. So it was a great start.
How was that company situated come 2008?
Well, so they continue to grow. I mean, they're one of the largest landlords in New York City today. I don't know how many units they have. I'll bet you they have 50,000, 80, I don't know, a lot of units.
Okay. Yeah.
So, I mean, they made it through the downturn. There were a couple projects that I actually went through back in 2001, 2, 3 with them where, we bought a project. We had very little equity in the deal. The market was good at the time. And all of a sudden the market started to turn. And so we said, okay, well, what are we going to do? And one of my projects was to recapitalize that particular project and get it back on its feet. And so again, kind of right out of the gate, good understanding of, leverage, which can be great, but at the same time, you got to be prepared to pivot if you need to.
Right.
And so we worked hard, recapitalized it. We took out a piece of debt that was kind of a mezz debt, a mezzanine piece of debt, replaced it with some equity, got a good, strong balance sheet partner on the books. And I want to say 3-4 years later, we actually sold the property and made about $30 million because of that.
Okay.
So, that was, for me, that was a great starting point of a lifelong lesson in real estate, that if you buy quality real estate in a good market and you have the liquidity to survive a downturn, it's pretty tough to lose money. It really is.
Yeah.
Real estate is just one of those asset classes that you do need liquidity. But if you're reasonably competent and you keep the lights on and you can survive the downturn, you're probably going to do just fine. And that was kind of the lesson of that particular project.
Okay. All right. Very good. And how about COVID? You're getting multifamily, and there's all this talk going around about we're going to stop. Yeah. No one's going to have to pay rent anymore. How did you guys navigate COVID?
Well, first of all, I think, again, there was a lot of fear back in March, April of 2020. And a lot of guys said, oh, we're going to cut distributions because we don't know what's going to happen. And I kind of looked around at the data. I looked at what was happening in our portfolio. We were doing fine. And I said, no, we're not going to cut anything. We may need to in the future, but right now we're not going to. So we just kind of kept a steady hand. We have a good amount of working capital reserve on all of our properties, so that helps. But I just felt like we didn't really need to react to the market. Now, as you mentioned, there was some talk about this, nobody's going to have to pay rent and all this nonsense. And there was eviction moratorium, which probably cost us somewhere in the neighborhood of $500,000 to $1 million. That, effectively most of that came out of my pocket at the end of the day. And, multiply that times however many thousands of other owners in the country.
Right.
So, we could debate the fairness of that policy. But, one of the things, a little bit of a tangent here, one of the things that we did during that time period, and I felt like should have been done more, I actually went to all of our residents and I said, listen, if the government effectively has taken your job away and you don't have an ability to pay rent, let us know. And if you legitimately need assistance, I will personally pay your rent. And I meant it.
Wow.
And I felt like that was my antidote to complaining about the government doing what they did. Because, I think it's easy for all of us to complain and say, well, the government doesn't know what they're doing. And these people are just always blah, blah, blah. You complain. And it's not unjustified. It wasn't. But I always feel like, hey, what's my solution? What can I do to counteract? What's a better solution? And I felt like that was the right solution, to say, hey, we don't need eviction moratorium. If every single landlord in the country who has the means offered their residents, the ones that are, legitimately need help, offer to pay their rent, I don't think we would have needed the eviction moratorium. I think people would have worked it out. But, that was one small way that I felt like we could do the right thing.
Well, I applaud that. And again, that whole wealth well done concept, you're going into practical application there. You've been blessed, and you're not just focused on self. That is you taking a selfless approach there. So I appreciate hearing that.
Yeah, and it's always a little bit painful when you get to the other side, and like we did a study of the folks who didn't pay rent during the COVID era, and arguably 80% of them had jobs the entire time, could have paid rent and just didn't.
Yeah.
So yes, was there 20% that legitimately needed the assistance? Absolutely. But there were 4 times that number of people who just flat out took advantage of the system. And that's disappointing, because that's not America. That's not how we, that's not how our country was built, and it's not how it works. So, frustrating, but it is what it is.
Okay. All right. All good lessons. So switching into a little bit more to really get into your expertise. First, I want to understand, how do you define and assess risk from an investment standpoint? If we're talking to investors who are looking at their nest egg type investment, and again, whether that's a significant portion of their nest egg, or if they're not as familiar with real estate and they're more dabbling, with less than 10% of their portfolio. Either way, how do you define and assess risk?
Yeah. Well, I think number one, your risk in any investment always comes back to the operator that you're invested with. So, maybe you look at Coca-Cola and you say, well, who am I invested with? Well, there's a brand, there's a management team, there's a track record. That's your risk. In a multifamily investment like ours, you're invested in me, you're invested in our team. Who are these people? What do they know? What's their track record? Are they honest? I think that's the number one risk that anybody faces in investment is the team that they're invested in, the people. Because at the end of the day, machines aren't making the world go round as much as we use machines.
Right. That's a great point. Yeah, that's a great point.
So I just tell everybody, I said, listen, you got to do your homework. You've got to assess the risk of that team that you're invested in. And that's one of the reasons that I really like multifamily, or I shouldn't just say multifamily, but I like the type of investment that we offer because it's direct. You're able to, as an investor, pick up the phone, call me, and ask me about a particular deal. How is it doing? What's the leasing look like? How's the cash flow? You can't do that with a standard stock market investment. And I'm not saying that you shouldn't invest in the stock market. That's not my point. But I love the direct approach because I think it creates a lot of good accountability. It takes a little bit more work, but it creates some good accountability. And going back to your question, it really mitigates a lot of the risk that I think you see when you have, I don't know how many hundreds of millions or billions that were lost with FTX as an example.
Right.
Very little accountability.
Right.
So those are the things that, to me, they always come back to the person, the team. Now, I think the asset class certainly has risk to it. I think we would all agree that crypto, as an example, is riskier than real estate.
Yep.
But it depends on what kind of real estate. And, you know a lot more about crypto than I do, but I'm kind of generalizing.
Well, but you're spot on too.
Yeah, I think at the end of the day, certainly the asset class has a component to that risk. And, I think multifamily, historically speaking, has been one of the lowest risk investments in general. So not to plug multifamily, but just kind of getting back to your question about how do I assess risk? And I think it's the team, number one. And number two is the actual asset class or investment vehicle that you're using.
Sure. Okay. All right. You spend a lot of effort trying to educate your investors. You've got your CEO blog. You do tons of informational videos. And if someone wanted to get online right now, if they search YouTube for REM Capital, just find a bunch of different educational videos. Some short minute-long videos and some are an hour long. And you put a lot of effort in educating your investors. What's the intent behind that, and what's the fruit that you see out of that?
Yeah, well, and I appreciate you asking that. I think the number one reason for that comes back to the whole risk question. How do we assess risk? Well, we assess risk by getting to know the team and asking the right questions about the team. So my goal through this educational process is to bring a lot of folks into the real estate space that haven't been in the real estate space, educate them about the opportunities that are there, but then also give them the tools to actually weigh the pros and cons of not only the investment vehicle, but the actual team that they're partnering with. Because the more educated that they are and the better decisions they can make, obviously that benefits all of us. We don't want people out there investing in a Bernie Madoff Ponzi scheme. We want people investing with a good company, that's going to be around in 20, 30 years because it helps all of us.
Right. Absolutely.
So that's really the driving force behind that. I think too, sort of secondarily, we're in a relationship business. I don't know. I guess you could argue that maybe it doesn't have to be that way, but I really believe that business is a relationship. Any business is a relationship business. And so for me, educating our investors is a way to build that relationship with them through education, through adding value. And, you've heard me say this a lot since we've been working together. I'm just big on, guys, I want to give much more than I'm asking. So, what am I giving out? What am I adding value to before I ever make the ask? And sometimes you may not even have to make the ask because people, they kind of look at the content and say, wow, these guys care about us. They seem pretty knowledgeable. What do you do? Oh, you're in commercial real estate. Okay, interesting. Oh, you got any spots open? So it's just a totally different mentality. It happens to work for my personality. I'm not a sales guy. I don't like being a pushy sales guy. So I just kind of set off and said, well, we're going to try to do it the unsales way and see if it works.
I love it. I think I absolutely admire that. I have a lot to learn and grow from that side for the other phases of my business to be more educational first. I think that's an opportunity for me, and I am learning and taking a page out of your playbook there as well. So
it's a great mindset. I think it's a great mindset, and I think on a personal level, it keeps your focus in the right place too. And I appreciate that because, again, as I mentioned at the beginning of our chat here, I think subconsciously money tends to be number one for the best of us.
Sure.
And so how do we constantly kind of bring ourselves back? And I think by generating and creating and cultivating a culture of giving, it balances that out subconsciously, and that's important.
That's a great point. It's the sneakiest idol.
Yes.
Money is the sneakiest idol. Most Americans would not think that they have idols because they don't have wood carvings and that they bow down to. But man, if you look at the amount of time and effort we put around money, I think it'd be tough to make a case against money not being an idol and honestly in most of our lives. And so it's a sobering thought. But
there's if you got 1 minute, I'll just share a quick story. I saw a Wall Street Journal poll recently. I think it was this weekend, came out, and they had kind of done a cultural poll of America. Obviously there's a margin of error and all this kind of good stuff, but I thought it was kind of fascinating. So in general, religion, drastic decrease. People saying that religion was important to them, drastic.
Right.
Children and family, drastic decrease, not important anymore. Being involved in civics, drastic decrease. No, who cares? Waste of time.
Yep.
The one thing that was consistent across the board, Republicans, Democrats, independents, you name it, age, doesn't matter. Everybody said money was the most important thing. And, I thought, well, it's not surprising, but that is our culture. And so I think that we can make a difference by being a little bit unique in that respect. And I don't think long term, with money being number one, that we will be successful. I think short term, if you put money first, usually it looks pretty good.
Sure.
But I don't think in the long term it works that way. And so, I look at my kids, my grandkids, my great grandkids. I look at REM as a generational company for lots of generations of investors and their kids to benefit from real estate.
Yeah.
But hopefully in a productive way, in a positive way. And, we can do something in a good direction for society. So anyway.
Well, let's, so before we go into the macroeconomic climate, let's stay on family for a minute here. Family, faith and the combination of that. So you are, a lot of people view themselves as too busy, right? Too busy. We wear that as a badge of honor. How you doing? I'm busy.
Yeah.
You have every right to be busy. Some people are busy on a much lower workload than you. You have a large family, a growing family still, and a large business that's growing. That's spread across a good chunk of the United States. How are you trying to? I'm going to coin the phrase of the podcast. How are you trying to do your wealth well done? How are you trying to steward money well, not only from a faith perspective, but also from a family perspective, and show your children work ethic and not let them just develop an entitled attitude?
Yeah, well, that last part is a big challenge.
Sure, but a lot of people listening to this podcast are going to be in the same boat, and so that's the idea. Is let's all share, learn, and grow together.
Yes, yeah. Well, I'll start with kind of the big picture. Which I would say is setting your priorities in the right place, setting your vision, setting your goals. And I think, none of us is going to do it perfectly. We know that. We're all going to make mistakes. We're all going to fall short of our goals, our ideals, what we should do, whatever that is.
Yep.
But one of the things that helps me is to really on a daily basis, sit down and kind of realize that, look, there's no way that I can get everything done that I need to get done today. Just no way. And if I try to accomplish that, I'm going to sacrifice something that's more important. So I have to be willing to, first of all, let certain things go, but I have to be, let's call it wise enough, business savvy enough to know what things can go by the wayside and what things can't. And I think that's a skill. It takes time to develop that skill. And that's one of the things that I try to work with our folks on our team in terms of prioritizing. What are your top 3 things? What are your top 5 things? What are you trying to do this week? It sounds very practical, but I think it's practical as well as spiritual. I really do, because if you do that practically, it actually helps keep your mind clear spiritually as well. So for me, that's one of the things that I try to do every day, and just realize, hey, I can't do it all. What are the most important things that I need to accomplish? Okay, I need to do this, and this on the business. I need to stop work at this time, spend some time with the family. I need to disconnect for this amount of time, whatever those things are. And I just literally every day just remind myself, okay, those are your 5 to-dos. Just get those 5 done. Okay. Of course, you get a lot of other stuff done in the meantime.
Sure.
But I really feel like just coming back to that, it's amazing how you can be successful with that simple mindset. And I guess, maybe simple is an understatement, but it is kind of simple. It's just, hey, what are the most important things that I need to get done today?
Right.
And don't worry about the rest, because you can't control everything.
No, absolutely right. Yeah, someone had shared with me the top 1 of 5 principles. What are the top 5 most important things that I need to get done today? And then what's the top 1? And I don't go to number 2 until I finish number 1. If all I do today is work on the most important thing, then that is time best spent, not all of the little things of, well, let me go through and clean up my Outlook calendar for 3 weeks from now. That's not what's important today. So,
right.
Okay.
Yeah. I can't tell you how many times I'm in the evenings sitting with the kids, with my wife, spending time with them. And I'm just thinking, oh my gosh, I've got 500 emails I need to work through. Oh my gosh, I got to do this underwriting. I got to finish sending, doing this report. I got to call this so-and-so. I got to I'm like, I talk to literally talking to myself. I'm like, dude, you just need to forget about it. Just stop. Just stop. Because you're not going to get it all done. And, obviously at the end of the day, you have to be honest with yourself and say, well, if I'm consistently got all this stuff getting done and I'm not able to honor my obligations to my investors and my employees, okay, then I need to figure that out. I need to hire some help. I need to, restructure the business. So there is a practical component to it. But there's a point where you have to just say, hey, we've got it covered and we're not going to get everything done. And, that's life, and you got to keep your priorities straight. Yeah. The beauty of it, I think, is that when you do that, it's amazing how I believe that God will kind of fill in the blanks, if you will.
Yeah.
And, it's not some, I don't know, I'm not trying to be overly weird about it, but it's not some, weird thing. It's just, I just don't think those things end up being as important as they seem to be at the end of the day when you keep your priorities in the right place. And it's a freeing experience. It really is.
That's true to life. I mean, that's a message I share regularly on the, I think it was Francis Chan maybe used an analogy of he had a rope he had a small red end on it and then this long, massive rope. And he said, this is life right here, from beginning, birth, first kiss, whatever, big thing that happened in school, marriage, and on down the line, kids, and anything else that's happened that seemed like such a big deal in the moment. As soon as you get on the other side of that, that death, as soon as you get on the other side of that, that's where Paul says, the cares of this world won't even be worth considering. And it just, from an eternal perspective, it doesn't, all those things that seem so big, whether it's the email that seems so big tonight, or it's the, how are you going to navigate, this current macroeconomic climate that we're going to get into, right now, like at the end of your time, that won't matter at all. And so just from that perspective, it absolutely gives peace. And, that's a liberating feeling, no doubt about it.
That's true. That's true.
I think on that note here, we will go ahead and we're going to cut this into two episodes. So we're going to stop this one here and then pick up next week we're going to dive into the macroeconomic climate here, how Robert is looking at investing in a rising and falling interest rate environment. We're going to go over some other stuff there, hit the banking crisis as well, and also talk about the the development that Robert has going on here in St. Petersburg. So join us next week as we go ahead and continue this conversation with Robert. Thanks for joining.
Thank you again for listening to Wealth Well Done. Be sure to subscribe to the show on your favorite podcast player, and together we'll continue to improve our relationship with money and our effectiveness in stewarding it well.